inflation. So here we will be trying to understand the impact of inflation on interest rates, and we'll also try to differentiate between the money rate of interest and nominal rate, nothing but real rate and the nominal rate. And as I mentioned, we'll be making certain investment decisions by considering both real term and nominal terms. And we'll also be focusing on the tax effect on discounted cash flows. So how the tax will be affecting the discounted cash flows. Then with that particular tax effect, we'll be calculating the NPV at present value. Then we'll also focus on the effect of working capital. So the major factors or the major elements which we'll be discussing here is impact of inflation and calculation of investment appraisal techniques by using real rate and monetary rate, nothing but money rate. And we'll also consider the impact of tax and how we should consider the tax for calculating the NPV. And finally, we'll be focusing on the working capital. And do remember, this chapter 4 is very important for your 20 marks. So I want everyone to be please very clear, and if you find any difficulty in any particular term, please make yourself comfortable and ask me the question. Very, very important. You can't even think about an FM paper without a question on this particular chapter. Okay. Yes. So first, we'll be going with the first element. Inflation. Now, what do you mean by inflation? I hope most of you might be aware about this particular term. What does it mean? Inflation means, of course, here the meaning of inflation is given. You can easily see this. But in your general terms, what does it mean? Yes, supply of money is more in economy. Okay. Decrease in the value of money, 6%. I didn't get this 6%, Farhan. What does it mean? So James says that supply of money is more in the economy. Now let me add one more sentence to this. Now generally, yeah, 6% per year. Okay, okay, very good, very good. Yeah. Now generally, if the supply of money is more, if in an economy the supply of money is more, now there is a possibility of increase in the income level. It means that the income level of the public will be increased, and if because of increase in the income level, the here problem is the purchasing power will also increase. It means what I'm trying to say, if the income level increases, definitely we can expect an increase in the price of the products, right? So I want to give an example to the James. Government prints more notes to cover fiscal deficit. Yes, I completely agree with you. Recently, did you heard about any country which dumped the currency in their economy? Any country which dumped the currency in the economy? It means simply they printed the notes and they dumped it into the economy. Any economy? Anyone? Any idea about? Did you heard about this? Yes. Not exactly Sri Lanka, to certain extent. Yeah. Now let me clarify this. In Zimbabwe, actually, they dumped this currency notes in the economy, and I don't know the exact figure how much money was circulated in the economy, but they simply printed the currency notes and they distributed among their public. And you don't believe, because of that particular effect, inflation was approximately more than 100%. So there was a small example in order to understand the effect of this dumping the currency in the economy. So in order to purchase 1 kg of tomato, they used to carry 1 kg of currency notes. Now just try to imagine the effect of inflation. Yes. After that only, because all these $1 trillion note, all these were circulated, James. So here just I'm trying to explain that if current if these currency notes are dumped in an economy, now definitely it will cause a severe inflation. And Venezuela also affected with this, and some European countries also. In order to what is this minimize this poverty, they do dump this currency in the economy. But instead of getting a positive result, they were actually facing a very severe adverse results because of this particular act, right? So inflation is a major factor. Now, how we can link the inflation to our investment appraisals? Normally, if you can recollect, when we are calculating the internal rate of return or when we are calculating the net present value, we are considering an estimated cash flows. It means if you start a project today and we are estimating the yield of the project as cash flows in future. Now, this particular estimated cash flows will definitely affected by this particular inflation, because previously we didn't consider the inflation. We assumed a particular cash flow. Let us assume that in 2020, if I start a project and if I am expecting the return in 2021, so by considering the situations in 2020, I'm trying to calculate the cash inflow in 2021. But here I'm not considering the inflation. See, definitely inflation rate will not be the same in 2021, right? Either it might, definitely in most of the changes, chances it might increase. So here in this particular inflation effect, we adjust the cash flows. We will be adjusting the cash flows by considering the inflation. So here you can see in times of inflation, the fund providers will require a return made up to two elements: real return for the use of the third fund and the additional return. Now let me explain the additional return and the real return. Suppose I take example of I'm taking James as an example. Let us assume that I gave 10,000 rupees to Mr. James for a period of 3 months. Now let us assume that today with that particular 10,000, I thought of going with a mobile phone. I want to purchase a mobile phone. But instead of doing that, I gave this 10,000 to James for a period of 3 months. And I expect him to pay a return of 5%. It means that when he is returning my uh, amount, he need to return with extra 5%. Now this is a contract between my James and myself. But in this particular period, the inflation was 5%. It means that the common increase in the prices of the product is 5%. So, can I consider the 5% which is paid by Mr. James as my real return? Because in this period, in this holding period, the inflation rate is also 5%. If he pays 5% to me, can I consider the 5% which is payable by James as my return? No, definitely no. Because just he is compensating the inflation only. Suppose if you would have paid 8% to me, that extra 3% in addition to the inflation, I would have considered it as my real rate of return. Instead of paying 5%, if you would have paid 8% to me, that extra 3% should be considered as real rate of return. It means that we will be adjusting the inflation, and after adjusting the inflation, whatever the excess return I am expecting, that is considered as real rate of inflation. I hope the concept is clear. So while calculating the NPV, we do calculate by using both nominal return as well as the real return. So before going with the formula, any query on this discussion? Is that clear? Can I move on? Yeah. So just see the formula. The real and monetary nominal returns are linked by the formula. Here you can see 1 plus I is equal to 1 plus R into 1 plus H. H is nothing but inflation rate. R is nothing but real rate. And if we are calculating money rate, so we can calculate this by using this particular formula. So I request everyone to please just see the formula. 1 plus I. I is nothing but money rate is equal to real rate and the inflation rate. Okay. It means we will be considering the compensation for inflation, plus we will also be considering the real rate which you are expecting from your investment. So if you add both, that will be considered as money. So there is a small query. With this, you can easily understand. An investor is prepared to invest $100 for 1 year. He requires a real return of 10% per annum. So he is expecting a real return of 10%. Real return in the sense without considering the inflation. It means uh, you are expecting 10% for nothing but for that particular investment. You don't want any inflation effect in that. So your real rate of interest is 10%. And in addition to this, you want to compensate. It means you want your investment to compensate your inflation effect. Now let us assume that the current inflation is 5% per annum. So your investment need to compensate your inflation of 5%, and it should also give a real rate of 10% to you. So what money rate of return which nothing but he will be requiring. So just to compensate for inflation. Now in order to compensate for inflation, it is inflation rate is nothing but 5%. It means it should be 105. If you give if you invest 100, it should be 105, and to give a real rate of return. Now real rate of return means your whatever inflation adjusted return, expected inflation adjusted return is there, on that how much you are expecting a real rate? 10%. So it means that if your investment gives a return of 115.50, now we can assume that it compensated your expected return plus the inflation rate. So what should be the actual return? What should be the money rate which you need to expect from your investment is 15.50. So just go through this. Very simple. First, we will be considering the inflation. So if you invest 100, what will be its value by considering the inflation? So it will be 105. And how much return you are expecting, how much real rate you are expecting on your investment? 10%. So it means that if you invest 100, if it gives a return of 115.50, it covers both the real return and as well as the inflation. So the total expected return from the project should be 15.5%. Now most of the students, what they will do, they simply add 10% and 5% and they consider it as money rate. No. Real rate should be calculated on adjusted inflation rate. Real rate should be calculated on adjusted inflation rate. So do remember, never try to just add this 10% and 5%. That is not our money rate. Okay, so here how we got the 15.5%? Initially we invested 100, and if your investment gives a return of 115.50, so it means the excess return of 15.50 divided by your initial investment of 100, it gives 15.5. So this should be considered as your money rate. So just look into this and let me know if you have any questions. Any question on this? So directly you can use this particular formula for calculating the real rate of return, sorry, monetary rate of return. 1 plus I is equal to 1 plus R into 1 plus H. Okay. Shall I put it in Excel sheet for your understanding, or is it clear? Yes. Okay, I will be explaining it once again. Yeah, I will be explaining through Excel sheet. I hope you are not finding any difficulty in my voice. I hope my audio is comfortable. So money rate. So money rate, that is 1 plus I, 1 plus I is equal to 1 plus H, 1 plus R. Now in the previous illustration, they gave inflation as H. H is nothing but inflation. So they gave inflation as I believe 5%, and they gave a real return. How much they are expecting a real return of? Not 10%. Now here what we need to calculate, the money rate. I is nothing but money rate. So just try to apply it in the formula. Suppose first 1 plus I. So I is nothing, sorry, 1 plus H, that is nothing but inflation 5%. Then R 10%. So we got 115.50. Now generally I is equal to, now your formula is 1 plus I is equal to this. So 1 plus I 115. Then finally I is equal to, that is our inflation rate is equal to 115 point minus, or nothing but 115.50 minus 100. So our money rate is nothing but 15.5. Okay, is that clear? Because you can expect an MCQ also. Conversion of money rate, sorry, calculation of money rate, or they might give real rate and money rate, and you should calculate the inflation, or they might give the inflation and money rate, you should calculate the real rate. So you can expect an MCQ like this. So let me know if you have any difficulty in understanding this calculation. Is that clear? Last step is very simple. 1 plus I is equal to, actually 1 plus I, we got it is equal to 115.50. So simply I is equal to 115.50 minus 1, nothing but minus 100. So it will be 15.5. So whatever value you got, just deduct the 100 from there. So 15.50 is nothing but your interest, nothing but money rate of interest. Is that clear, Mohammed? Very simple. No need to confuse here. From 115.50, just direct, yeah. One, it is one, we assume it as 100. So the basic logic behind is, if I invest 100, it is giving 115.50. So whatever extra is there, that is nothing but expected return. Now don't go much into the mathematical calculation. Very simple logic. My investment is giving 115.50. Now I assume that I invested 100. So whatever the excess amount is there, that is nothing but my investment. I believe you might have understood the logic, Akshay. Once again, I repeat, very simple. Finally, you are getting a return of 115.5. Your assumed investment is 100. So the excess is nothing but your investment. Okay. Now, will you try this one? Test your understanding one. 1000 is invested in an account that pays 10% interest per annum. Now, inflation is 7% per annum. Now, they are asking us to calculate the real rate of interest. So, I value is given. The total I value is given, that is 10%. Now, the inflation is 7%. Don't simply subtract and say that 3% is your real rate of interest. So, what is the real rate of investment? Just use the same formula. 1 plus I is equal to 1 plus H into 1 plus R. I hope you are trying this. Did anyone calculate it? So here they gave 1 plus 10%. So 1 plus H 7% they give. 1 plus R. So we need to calculate the R value. So what will be the R value? So I believe with this you can easily get. What will be the R value? So 1.10 is equal to 1.07 into 1 plus R. Do anyone trying this? Yes, I am giving 1 minute. So please go to site. Definitely you can calculate this. Okay. Am I audible? 2.8 approximately. Okay, I got one answer. 0.028. Yes. And how you did this calculation? It means are you using your Excel sorry, laptop or just on the calculator you did it? Let me show this. Okay, so I think most of you might have done through calculator only. Okay, so Hadi Excel. Okay, very good. So I hope you don't find much difficulty in understanding this. So if you, for your reference, once again I'm showing this. Yeah, right. Okay. Next. So I hope it is clear. Shall we go with the next one? Yeah. Now, do remember in your exam also, you should be very careful. Suppose if they ask you to calculate the NPV by considering whether they are asking us to calculate by using monetary rate of interest or real rate of interest, because both the methods can be expected, either money rate or real rate, and we should see what rate they give. So they may give only real rate and inflation, and you should calculate the monetary rate, then you need to go for the calculation. So it should be, because as I mentioned, this is a 20 marks expected question, so you should very careful, you should be very careful with the returns, whether asking to calculate by using monetary return or whether they are asking you to calculate. Yeah, 0.28 is the right answer. It is correct. So it means that 2.8, so 2.8% is your real rate of interest. Okay. Yeah. Now the impact of inflation on cash flows. So as I mentioned in the investment appraisals, how we need to adjust the cash flows, because we cannot consider the cash flows without considering the inflation rate. So where cash flows have not been increased for expected inflation, they are described as being the current prices or today's prices. This term is very important. Once again, I repeat, if cash flows are not increased for expected inflation, suppose let me give a small example. I started the project in 2020, and by considering the today's prices, I am expecting that my project will give a cash flow of $10,000 after 1 year. It means by considering the present prices or the today's prices, I am expecting that the project will give $10,000 as my cash flow after 1 year. Now here we should, it means that they clearly mention that it is the cash flows are at current prices only. So in some questions, we need to adjust the cash flow by considering the inflation. Suppose example, in the given example, I mentioned that 10,000 is my expected cash flow as per current prices. Now we need to calculate the adjusted cash flow. So how we will be getting the adjusted cash flow? By considering the effect of inflation. Suppose during 1 year, if you are expecting the inflation as 5%, then 10,000 plus 5%. 10,000 plus 5%. Nothing but my expected cash flow should be 10,500. I hope you might have understood this. So if the inflation is not adjusted, we assume that cash flows are projected at its current price or today's price. Now where cash flows have been increased to take account of expected inflation, now generally we say it as nominal cash flows or money cash flows. So try to understand the difference between this, because in exam you need to clearly see whether they give money cash flows or the current prices. So money cash flows or nominal cash flows are nothing but cash flows adjusted with the inflation effect. So if they do take inflation into account, they represent expected flow of money, hence the term money cash. It means that if they clearly mention that inflation is already considered, then whatever cash flows which are given in your query, we should assume it as money cash flows, because these is very, very important. So we should see whether the cash flows are today's prices or whether it is adjusted cash flows, nothing but money cash flows or nominal cash flows. Now here you can see, you can assume that the cash flows you are given in the exam are money cash flows unless and until told otherwise. This is a very important point. If they specifically didn't mention whatever cash flows which are given, we should assume those cash flows are money cash. Suppose if they mention that the cash flows are what is this current cash flows, then you might go with calculating the money cash flows. So if the examiner specifies that the cash flows are in current terms, you will generally need to put these in money terms before you can discount them. Anyway, there is a specific procedure for that. I will be explaining that. Now make sure you read the question carefully, and sometimes you will be given the cash flows in year 1 terms with the subsequent inflation. So here you can see this. Just if the question tells you that sales for the next 3 years are $100 in the current term, but are expected to inflate by 10%. These are the commonly style of asking the question. So sales for the next 3 years are $100 in the current term, but are expected to inflate by 10%. Now in that case, what should be the actual values? So year 1, the current term sales are 100, but at T1 is nothing but the first expected cash flow. So by considering the inflation of 10%, then your sales would be 110. And the second year, and another increase of 10%. So 110 plus 10%, it will be 121. And the third year, 121 plus 10%, it will be 133.10. I hope you might have understood. Suppose if they says that sales for the next 3 years are $100 in the current term, but are expected to inflate by 10%. So in that case, we need to add 10%, then our sales cash flow should be 110 for the first year, plus 10%, that will be 121 for the second year, and plus 10%, that will be 133 for the third year. And similarly, if the question says sales will be $100 in the first year, but are they going to inflate 10% for the next 2 years, then the sales will be, this is very important. Sales will be $100 in the first. Just try to understand the difference. It means that first year we will be considering our cash inflow as 100 and then 10% inflation for the next 2 years. So just see the difference between these two statements. Because Around 70% of the students, they end up with wrong answer with this confusion only. So that's why I'm clearly projecting this. Please, if you have any query, let me know. Most of the students commit mistake here only. Try to understand the difference between the first query and the second one. Once let me know once you go on through this. I hope this clear. Is it clear? Yeah. Now, so the impact of inflation, there we do have two methods. So generally both the methods give the same. So let me show what are those two methods and how to calculate this. Now this is very, very important, not only for financial management, this is important for your AFM paper also. So how the inflation should be done? What are those two methods? Now the first method, that is real method. Now under real method, first they see this, do not inflate the cash flows, leave them in the real terms, that is in today's prices, real flows. And you need to discount it by using the real rate. It means whatever cash flows which are given in the exam, don't try to make any changes to that cash flows. But when you are discounting it, suppose you will consider a discount rate, maybe 9% or 10%, whatever the discount rate which you are considering. Now we need to discount it by using the real rate. You need to discount it by using the real rate. Now this is the procedure for calculating the real rate. Now how to calculate the real rate here? They might have given the money rate and they might have gave the inflation rate. So by using that money rate and the inflation rate, you should calculate real rate, and that particular real rate should be used to calculate nothing but to convert it into present value. Now this is applicable if you are following the first method, that is real. Now in case of second method, that is money method or the nominal method, you need to adjust the cash flows with inflation. You need to adjust the cash flows with inflation, and whatever the money rate is there, that can be considered to discount it. Now with an illustration, we try to understand between these two methods. And do remember, two methods give the same answer. For calculating NPV, you can go with any method, real method or the money method. So two methods should give the same answer. Okay. Now shall we have a discussion with an illustration? So Stormco is evaluating project X, which gives an initial investment of $50,000. Expected net cash flows are 20,000 per annum for 4 years at today's price. However, these are expected to rise by 5.5% per annum because of inflation. So the company's cost of capital is 15%. So the company's cost of capital is 15%. Now we need to calculate the net present value by using money cash flows and the real cash flows. So first we'll go with the money cash flows and the real cash flows. Okay, so sorry, first we'll go with the money cash flows. Now, if you can recollect, if you're going with money cash flows means we need to change the cash flows. So expected net cash flows are 20,000 per annum for 4 years at today's price. At today's price. So however, these are expected to raise by 5.5%. Now let me ask my first question. What should be the cash flow for the first year? Is it 20,000 or 20,000 plus 5.5%? If you didn't get my question, let me know, I will repeat. 20,000 plus 5.5%. So Naina thinks, yeah, so yes, 20% plus 5.5%. So shall I show its calculation? So directly I will be showing it. Very simple to understand. Because unnecessarily I don't want to use that. Right? So what I said, as per the first method, we need to change the cash flows. So inflation is 10%. Sorry, 5%. So the first cash flow 20,000 plus 5.5%. And again, whatever value which you get here, you can see. So if you are finding difficulty in understanding this, let me know. I will be showing it in Excel sheet. So choice is yours. Is it comfortable to understand this, or you want me to put it in Excel sheet? As you wish. Shall I show the calculation in Excel? Okay. Suppose total 5 years are there. Sorry, 4 years are cash flow. So the cash flow first year we need to adjust. So just see the formula. 20,000 into 1 plus 5.5%. Okay, 20,000 into 1 plus 5.5%. So your cash flow, will be 21,100. So see, this is the first year. And what will be the cash flow for the second year? Just take this 21,100 into 1 plus 5.5%. So it will be 22,260.5. Nothing but 22,261. For the third year, into 1 plus 5.5. And the last. So these are the cash flows. Any query on this cash flow calculation? Is it clear? Now here you might have confused why they took 2, 3, 4. So this the power the second year, third year, fourth year. So if you're not comfortable to use the power directly, you can do this. First year, second year, third year, and the fourth year. Now the discount factor So why are we adding is, see, actually what we are trying to do here is 20,000 plus 5.5% increase, right? Now normally in Excel sheet, if you want to get a value by adding a specific percentage, we'll use it as one place because 20,000 and plus 5.5%. So what will be its value? It is 21,100. So in the Excel, you need to give this particular formula. Okay. Because this percentage is calculated on this, and again this amount should be added to this, right? We are not just calculating the percentage 5.5% and 20,000. If it would have been 5.5%, 20,000 means simply 20,000 into 5.5. But we want this amount to be added to this 20. So that's why I'm using the value 1 place. I hope I addressed your query. Yes, yes. Okay. Now the discount factor, how much they give? Money rate? I'm not sure. Do anyone recollect what was the money rate? 15%. Okay, thank you. So discount factor is calculated at the rate of 15%. And from here it is same procedure. Same you need to calculate the discount factor at the rate of 15%, and again we should go with this. So 1 divided by 1 plus 15%. So for second year. This is the same procedure which we generally use for calculating the discount factor. Then present value. So total sum. So finally our net present value will be NPV. Present value of cash inflow 64,787 minus initial investment 50,000. So NPV would be 14,787.66. This is as per using the money cash flows. So I hope money cash flow is clear. Any query? Yes. Now in case of next one is real cash flows. Now in case of real cash flows, as I mentioned, there will not be any changes to the cash flows. So whatever cash flows which are given in your question, same cash flows we will be considering. So we won't inflate the cash flows. So that is 20,000 per annum. So same 20,000 will be considered. Then discount rate. Now in case of discount factor or the discount rate, now we need to calculate the real rate of discount. So can anyone let me know what will be the real rate of discount here? Inflation, they gave it as 5.5% and money rate, they gave it as 15%. So I already showed the formula for calculating the real rate. So I want you to please calculate it. So just now previous query we did that. So what will be the real value? For your for your understanding, let once again I am showing the formula. I believe you can use that and you can easily calculate. Yes, I am showing the formula. Yes. So same formula you can use. 9%. So this form. So is it 9%? So this simply 1.10 divided by 107. Now in this case our money rate is 1.15 divided by, and our inflation rate is 1.055, right? So finally our real rate of return will be how much? 9%. Is that clear? Do anyone find difficulty in understanding the calculation of real rate of return? See, if you find difficulty, a simple logic is there to calculate the real return if inflation and money rate is given. So the formula directly what you can use, say here you can see this I am writing the formula also. It will, I think you can easily understand this. 1 plus money rate. Money rate is nothing but I divided by 1 plus inflation rate. Okay, that is nothing but H. So with this formula, you can easily calculate the real rate of. So in this case, if I applied this, I got 1.09. So 0.9 nothing but 9% is my real rate of return. I hope you understood it. Is it clear? So my discounted value is 1 divided by 1 plus 9%. So present value. So NPV, final NPV will be 64,794 minus, so 14,794. There is a fraction of difference because we got 9 point something, so directly we took it as 9%. So as I said, in both the cases, there will not be any change in your NPV. So this is the calculation of NPV by using the real cash flows as well as money cash. So just look into the calculations, and if you have any query. Any questions? Yeah, you can take discount values from your present value also. But the problem here is, Vikrant, suppose when you calculate the real rate, there is a possibility that you might give 9.7% or 9.8%. It means you might get in decimals also, but you won't find it in present value, right? See, of course, 9% might be there, but 9.5%, it won't be available. So there you might find difficult. I hope you understood, right? So that's why it is preferable to use the formula here. If you directly get a value, single value 9 or 10, then no issue. You can take that. Okay. So I hope this calculation is clear for all the participants. Shall we continue? Yeah. Now a project has the following cash flows before allowing for inflation. So they are stated at their T0 values. So the company money discount rate is 15.5%. The general rate of inflation is expected to remain constant at 5%. So the cash flow and 3 years are given, 330, 242 and 532 is given as cash flow. Do remember, the project has following cash flows before allowing for inflation. Is it money cash flows? Before allowing for inflation they give. So real cash flows and real discount rates, money cash flows and money discount rates. So I hope you can easily do this. So just try as your homework. I believe you can do it. I'm not sharing the screen, but actually I'm sharing my screen. I don't know what happened. No one can see the same or any. 1 second. Yeah, yeah. So Naina, I think some problem with your. Okay.
I didn't say, sir.
Yeah. So once try to reconnect. So shall I skip this? Will you try this one as your homework? Yeah. Now, next important concept is specific and general inflation rates. Now, specific and general inflation rate means, see, certain cash flows. It means that suppose if I take wages, so wages might be having a separate inflation rate. Sales will be having a separate inflation rate. Now, in that case, how to deal with this? So here you can see two types of inflation: specific and general. So specific inflation rates impacts all the individual cash flow items. Each cash flow is affected by a specific and general inflation rate. So impacts the investors overall required rate of return, and investors in the project need compensation for the lost purchasing power, which relates to their ability to buy a basket of all goods rather than any specific one. So for your better understanding, we'll try to discuss with an illustration. So is there one rate of return or no tax in the question? Here you can see. So money or nominal method. wages 3%, material 4%, and general inflation 5%. Inflate cash flows to the money terms method. And if the cash flows are in real terms or money terms, using this for the annuities. Okay, let me show this. So directly I will be explaining with an illustration so that it will be clear. Now here you can see a company is considering a cost saving project. This involves purchasing a machine costing 7,000, which will result in annual savings in real terms on wages cost of $1,000 and on material cost of $400. So the following forecasts are made of the rates of inflation each year for the next 5 years. So wages cost 10%, material cost 5%, general prices 6%, and cost of capital of the company real terms is 8.5%. So evaluate the project assuming that the machine has a life of 5 years. Now I will be explaining this problem with my Excel sheet. Let me open it. Can you see my screen? Hello. 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 Am I audible? Hello. Can you see? Yeah, yeah. So issue with my end only. Some network issue because of that app. Yeah. Yes. Now we try to discuss this question. I'm explaining in my Excel sheet. Actually, here I'm trying to decrease the font. Okay. So here they are companies considering a cost saving project. So initial investment for cost saving project would be 7,000. And with this investment, the company annual saving in real terms. So the company will be saving a wages of $1,000 and they will also save material of $400. But the following forecasts are made of the rates of inflation each year. So in this case, the wages cost inflation rate is around 10%, material cost is 5%, and normal general price inflation is 6%. And the company cost of capital in real terms, they gave real terms 8.5%. So the requirement is evaluate the project assuming that the machine has a life of 5 years and there is no residual value for it. Okay. So we'll go with the calculation now. So total life of the project is 5 years. So first, I hope you might have understood the question. Again, I'm briefing it. If you purchase a new machine, then the company will save 1,000 on wages and 400 on material. So these two are the expected savings with the new project. Okay. So now first we calculate how to calculate this cash flows. So first wages. Now what should be the wages for the first year? Actually, they gave the annual savings in real terms on wages cost is 5,000. So for the first year, should we consider the wages as 1,000 or we need to adjust the inflation of 10%? Actually, the annual savings in wages, they gave it as $1,000. And the inflation rate for the wages, they gave it as 10%. So what should be the value for the first year? Adjust inflation, yes. So what will be the inflation? 1,000 into 1 plus 10%. So the wages for the first year would be 1,100. So I hope the wages is clear. Is that clear about the first year calculation of wages? Then second year 1,100. Again it is going to increase by 10%. So second year it will be 1,210. That is the second year calculation for the wages. Okay, I will be repeating it once again. See, normally the savings, the wages is $1,000 and we are expecting that wages will increase 10% every year. So the first year, just see the formula 1,000 into 1 plus 10% because it is going to increase by 10%. So my wages for the first year would be 1,100. Second year would be 1,100 plus 10% increase. So it will be 1,210. And the third year 1,210 plus 10%. So it will be 1,331. And the last year, sorry, fourth year 1331 into 1 plus 10%. And the fifth year 1464 into 1 plus 10%. So these are the wages value. So before I go with the material saving, so let me know whether you are clear with the wages. Clear? Any question on wages calculation? Yes. I am expecting you to respond for this so that I can go with the next one. Yeah. So for material, now material, the savings in the material was 400 and the inflation for the material is 5%. So the first year it would be 400 and the inflation for this is 5%. So it will be 420 for the first year. So similarly, we need to calculate for the remaining 4 years. Then fourth year, and the last. So these are the wages. It means that if a company go with a new machine, they are going to save 1100 towards wages and 420 towards material for the first year. Similarly, 1210 for the wages and 1441 for the second year. So these are the cost savings of material and wages. And I believe this calculation is clear. So what will be the cash flows now? Total net cash flows. So net cash flows are nothing but we need to add these two, wages plus material. So 1100 plus material 420. So it will be 1520. So these are the net cash. Okay. Now we need to take the discount factor. Now what should be the discount factor which I should consider here? I adjusted the cash flows now. So here they gave the cost of capital of the company in real term is 8.5%. Now can I consider 8.5% as discount factor? Yes. Because if you can recollect, if I inflated the cash flows, I need to consider the money rate. But here they gave only the real rate. So real rate is given, yes. Real rate is given. Now we need to calculate the money rate. So what will be the money rate now? 8.5 is given and the general price index is 6% they give. So what will be its value now? So money rate is equal to, I hope you might recollect the formula. What is the formula for money rate? One plus the real return, that is 8.5%, into 1 plus the general price index, that is 6%. So we got 1.15.01, 1.1501. So what will be the money rate now? Money rate would be 15%. Yes. So money rate would be 15%. So discount factor at the rate of 15%. So what will be the value? 1 divided by 1 plus 15%. Okay. First I will be calculating discount factor, then I will explain the money rate. Yeah, I will be showing this formula. One second. See, money rate formula, 1 plus real rate of return into 1 plus 6%. 1 plus real rate of return, that is 8.5%, and 6% is nothing but the discount rate. So once again I repeat, to calculate the money, the formula is 1 plus real rate of return into 1 plus inflation rate. So in this case, our real rate of return is given as 8.5%. Then our inflation rate is given as 6%. If I multiply these two, I got it as 1.150. So no need to go much calculations here. 1.15 is nothing but 15%. Just remove this one. So 15% is nothing but your money. Is that clear now? Yeah. So we got the discount factors also. So the next step should be present value of the cash flows. You are multiplying with 100. So in this case, what will be the present value? 1520 into discount factor. Now these are the cash flows. I hope it is clear to all. So present value of the cash flows, then sum of present values. So here the sum of present values would be 5,919, right? The sum of present values, we got it as 5,919. Then what is our investment? Normally we will deduct our investment, right? In order to get the NPV value. So our investment is how much? They gave it as 7,000. So 5,919 minus 7. We got minus 1,080. It means we got a negative NPV. Investment is more than the present value of cash flows. Because we got a negative NPV, is it recommended for the company to go for new machine? No. Yes. Because the machine is not going to give the viable returns. So that's why it is not recommended to go with a new machine. So this is the process. I hope the calculation is clear for all. Any question on this? Just go through the calculation once again and let me know if you have anything. No, no, not required. Because here they didn't ask us. Because real rate of return is given, so directly we will be calculating. No need to go with it. Okay. Yeah. Yeah. So, and I hope this concept is clear. So this is the procedure which we generally follow for real rate and the inflation rate. So, and inflation rate also not required that every item will have the same inflation rate. So if you can understand here, wages is having a different inflation rate and materials is having a different inflation rate. So this is the procedure which we need to follow for this. Money rate calculation, what if we get 1.03? Just 0032 into 100, whatever percentage you get, that you should take. See, let me show here. Into 100. See, whenever you find difficult, just multiply it into 100. So how much you got? 0.32, na? So 0.32 should be your first. I hope it is clear. Any other query? Now the next one is dealing with tax in NPV calculation. I don't want you to confuse in one session only, but I want everyone to please once go through this. How to deal with tax in the NPV calculation. So any question on NPV with inflation? And some participants asked me to explain the illustration 12 once again. Can I know what is the main query you found difficult in understanding illustration 12? Basic difference between, okay, okay. So first let me address this basic difference between real cash flow and the money cash flow. See, do remember money cash flow and the real cash flow. See, whatever actual return which you are expecting from on your investment is known as real cash flow. Suppose let us assume that I invested in a bank and bank giving me 12% as rate of it. It is nothing but banker paying inflation during the year is 5%. Of course, the banker might be paying 12% to me. From the 12%, if I deduct the inflation effect, the whatever return which I get, that is considered as my real return. It means in addition to the inflation, in simple language, in addition to the inflation, whatever you are receiving, that is known as real return. Monetary return is nothing but it includes both inflation plus real return. Inflation plus real return is known as money return. And if you consider only the return excluding the inflation, that is known as real return. I hope I addressed your query now. Yes. Now the calculation of payback period. Okay. First, let me clarify the payback. So, which project payback method you want me to explain, or shall I calculate all the payback periods? As per my knowledge, there is some issue with payback period of G, because it should be 1.6, I believe. It should be around 1 year 6 months, as per my knowledge. Okay, let me go to this. Last two disadvantages of IRR. Okay, let me explain the first F and G. Now, in case of project F, the initial investment was So initial investment they gave it as 1 lakh 120, and the contributions nothing but the cash flows are also given. So for the first 4 years cash flows are say 15, but the 50 year the cash flows is 200. So in this case we need to go with the cumulative cash. Just one second. One second. I'm in class, so like I'll have to continue. Yeah. 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 So our investment is 120. So 1, 2, 3, 4 years. So it is approximately 4 years, 2 months, and 0.76 into again 30 days. You will be getting the value.
So,
Yeah.
I got a small query.
Yes.
When you've taken the 4 years
Hmm.
plus 120 minus 60,
Hmm.
then you put divide, correct?
Yeah.
Yeah. Why is it 260? Why isn't it not 200?
One. Yeah. Sorry. It is 200. Sorry. Yeah. Sorry. Yeah. Thanks for pointing. It is 200 because the difference between the cash flows we should consider. It is 200. All the so it means approximately 4.3. So 0.3 into 12. So 4 years, 3 months, and 0.6 into 30. Around 4 years, 3 months, and 18 days will be the payback period for it. Because in this case, when we divide it, the difference should be the difference between the current, nothing but previous cumulative cash flow and the current cash flow. The difference we need to take. So the difference is 200. Okay. I believe you understood this, Srivardhani. And in case of project G also, so only two cash flows were there, 120 and 80. Yeah. It should not be considered for this payback. One question, 17th question in page number 81. A company is considering a 2-year project which has two annual internal rate of return, namely 10% and 25%. The sum of undiscounted cash flow is positive. So sum of undiscounted without discounting, so the cash flow is positive. Positive cash flow is the total of the cash flow is more than the initial investment amount. So the project will increase. The project will increasingly have a positive net present value when the annual cost of capital is. Now, what is actually the requirement here? Here, they are considering a 2-year project and which has two annual internal rates. One is 10% and 25%. So the sum of undiscounted cash flows is positive. So the project will necessarily have a positive NPV when the annual cost, here the cost of capital is. So at what cost of capital the project will be having a positive NPV? That is the question. So what do you think? Yes. Suppose when NPV will be positive, in general, when NPV will be positive? I think you can easily guess it. When the NPV will be positive? When cash flows are more than it means the present value, when the present value of the cash flows are more than the investment amount, NPV will be positive. Okay. So by applying this, what do you think? Positive NPV when the annual cost of capital is. It means, suppose here annual cost they gave 20 more than 25%, more than 10%, between 10% and 25%, and less than 25%. Now, in this case, they already mentioned that they has two annual internal rate of return, namely 10% and 25%, right? So, annual internal rate of return means the expected return. It means the point at which the investments and the present value of cash inflows are equal. So, it means at 25%, the present value of cash flow will be, it means that investment and the present value of cash flow will be equal, and at 10% it will be equal. But here the specifically the question is, what should be the cost of capital? What should be the cost of capital so that the project will be giving a positive? Now let me focus on each and every option. More than 25%. Suppose if the cost of capital is more than 25%. Now, in that case, will it be have a adverse effect, or will it be a negative or a positive? Negative. Okay, I got an answer that negative. More than 10%, between 10 and 25, and less than 25. So, shall we consider that option A In that case, the NPV will be negative. Now more than 10%. Okay, now let me clarify this. Let me use my Excel sheet. Two annual return. Yeah, I will be. Yeah, this note will also be clarified, Naina. So let me focus on it. The two annual returns, internal rate of return, which has two annual internal rate of return, that is 10% and 25%. Now, first we try to understand what exactly this 10% and 25%. One thing is internal rate of return is nothing but the point at which NPV will be zero. So this point you need to remember. Now, if a project is having two internal rate of return between 10% and 25%, now what does it mean? If the project is uh, between, suppose example, uh, if the project is less than 10%, if the cost of capital, it means if the cost of capital is less than 10%, or if the cost of capital is more than 25%, in that case, the project NPV will be positive. Why it will be positive? Because it says that it is between the IRR, two projects are the 10% and 25%. It means at IRR at 10%, NPV will be 0. 1%. At IRR 10%, NPV will be 0. And at IRR 25%, NPV will be 0. Yeah. Now, in this case, they are asking what should be the cost of capital which we need to consider. Suppose if you consider a cost of capital between 10% to 25%, if it is between 10% to 25, in that case, we will be getting a negative NPV. If the NPV is between 10 to 25%, it means more than 10%, or if it is less than 25%, we will be getting negative NPV. At exact 10% of cost of capital and at exact 25%, our NPV will be 0. So in this case, if the project, if the cost of capital is more than 25, or if the cost of capital is less than 10%, in that case, we can expect a positive NPV. Because they clearly mention if at 10 and 25, it will be 0. Now we need more than 0, that is positive. It means that more than 25% or less than 10%. Now let me know if you understood this or not. Yes. Little. Why only little? What was the difficulty in understanding this? Yes. Okay, no issue. Yeah, if you can go through it, no problem. It means that if the cost of capital is less, if you're considering the cost of capital at less than 10%, in that case also we can expect a positive NPV. But in the options, 10 less than 10% is not given. Na? So that's why more than 25% is the cost of capital, which gives a positive. Any other query? Did I miss any question? Now here one more question. See, always it is recommended that IRR should be more than the cost of capital. Yes, that is true. IRR should be more than the cost of capital, but it doesn't mean that always suppose here if IRR is more than cost of capital, then it will be giving a positive NPV. Because in certain situations uh, the project it means the project at which it will be zero. No need to no, it is not required that it should be always positive, because IRR itself clearly says that IRR means where NPV is equal to zero. Suppose if I take 15% as my IRR, it means that my NPV is zero, not positive. But if this 15% is more than the cost of capital, yes, we can consider the project. In this case, we are not getting the positive, but it is zero. So in that case also, by considering the factor that it is more than the cost of capital, we may consider the project, or the project may be acceptable. I hope it is clear. So just do remember always IRR is a point at which it will be zero. NPV will be zero. So any other question? Yeah, always it would be appropriate to consider less than 10%. Correct. Yes, definitely it will be appropriate to consider less than 10%. If you compare more than 25 and less than 10% means, yes, obviously less than 10 is more suitable. Any other questions? I hope I address all queries. Did I miss any query? Okay. So if you know session, if you know queries means, so I can see that some students raise the hand. Any query? Yeah. So let me justify this. Why it is? See, one thing is, it is clearly mentioned that this project is having two annual internal rate of returns. One is either less than, one is 10%. So if the project IRR is 10%, NPV will be zero. And if the project IRR is 25%, the NPV will be zero. Okay. So when the NPV will be, it means the expected cash inflows will be equal to the expected cash outflow, nothing but initial investment amount. Okay. So the question is, the project will necessarily have a positive NPV value when when annual cost of capital is, suppose, let us assume that if your annual cost of capital is more than 25%, or if your annual cost of capital is less than 10, what is this, 10%. Now, example, if it is more than 10% and if it is less than 25, we will be definitely getting a negative NPV, because at 25 only NPV will be zero, at 10% only NPV will be. If it is more than 10 or less than 25, then you will be getting a negative NPV. But here the question is, what should be the cost of capital in order to get it into NPV as positive? So if your expected cost of capital is more than 25, if your expected cost of capital is more than 25, then definitely we will be getting a positive. But if you compare 25 and 10%, always it is recommended to have a cost of capital is less than 10%. I think most of your students are still facing confusion. Did you understood Srivardhani? Still facing the same? Okay. So once you go through it, okay, let me do one thing. One second. So just I request everyone to please carefully go through this particular chart. So tomorrow we'll have a discussion exclusively on this. First 5 minutes, I will explain what exactly it is. So I think with this, your thought will be carried. Okay. So tomorrow session I will explain this the chart. So if two IRRs are there, okay then. So that's it for today. And just remind me when I start the session tomorrow. First we'll discuss with this, then we'll go with the next one. Okay. So that's it for today. So this I'm ending the session. Tomorrow we'll